Welcome back to my YouTube family. This morning, the Social Security Administration released its official 2026 Trustees Report, and I need to walk you through what it says, because the numbers in this report directly affect every single person watching this video who is on Social Security right now or who plans to be on it within the next 10 years. Here is the headline. The Social Security Trust Fund, the reserve that helps pay your monthly retirement benefit, is now projected to run out of money in the fourth quarter of 2032. That is 6 years from today. And if Congress does not act before that date, the law requires the SSA to automatically cut retirement benefits across the board. Every beneficiary, every state, no exceptions. How much? The report says that once the reserves are depleted, ongoing payroll tax revenue will only be enough to cover 78% of scheduled benefits. That means a 22% automatic reduction. On a $2,000 monthly check, that is $440 less every single month. On a $2,500 check, that is $550 gone. Starting in 2032, without any warning, without any phase-in period, just your next check arrives and it is $400 to $500 smaller than the one before it. Now, before you panic, I want to be very clear about what this report actually says, what it does not say, and most importantly, what 5 specific things you can do right now to make sure you are in the strongest possible position, regardless of what Congress does or does not do between now and 2032. Stay with me through this entire video because the last section is the one that actually matters most for your financial situation. Before I get into the full breakdown, if you are not subscribed to this channel yet, please do that right now and turn on the bell notification. Here is why today specifically matters. The SSA released this report this morning. By tonight, you are going to see headlines across every news outlet in the country. Some of those headlines are going to say things like Social Security is going bankrupt or seniors will lose their benefits. And those headlines are going to cause real panic for millions of people, including people you know, who will not have anyone to explain what the report actually says versus what it does not say. That is exactly what I do on this channel. I take official government reports, strip out the noise, and tell you what it actually means for your check, your plan, and your decisions. If that is valuable to you, subscribe right now, turn on the bell, and let us go through this report together. What the report actually says. The real facts. The official numbers. Exactly what the SSA said this morning, nothing added. Let me start with exactly what the 2026 Trustees Report says, directly from the SSA's official press release published today at ssa.gov. The Old Age and Survivors Insurance Trust Fund, this is the fund that pays retirement benefits to over 60 million Americans, is projected to be depleted in the fourth quarter of 2032. That is 1 quarter earlier than last year's projection, which estimated the first quarter of 2033. The date moved up. Why did it move up? The report specifically names the One Big Beautiful Bill Act, signed into law on July 4, 2025, as a major factor. That law reduced income taxes on Social Security benefits for most seniors, which is good news for current seniors paying taxes on their checks. But the money the federal government collects from taxing Social Security benefits is one of the revenue streams that goes back into the trust fund. Less tax revenue from benefits means less money going into the reserve, which means the reserve depletes faster. Now, here is what happens at depletion, and this is the part most news headlines get wrong. Social Security does not stop. The program does not shut down. Benefits do not go to zero. What happens is this. The trust fund reserve is gone, but the program continues collecting payroll taxes from every working American every single week. Those ongoing payroll tax revenues, without the reserve as a supplement, will only be enough to pay 78% of scheduled benefits. By law, Social Security cannot pay more than it collects, so it pays 78% across the board. 22% cut. every beneficiary. No income test, no age exemption. A retiree getting $2,000 per month would receive $1,560. A retiree getting $2,500 would receive $1,950. That difference, $440 to $550 per month, is what is at stake if Congress does nothing between now and late 2032. One more important number from the report. The combined reserves of the Social Security trust funds declined by $160 billion in 2025 alone, down to $2.56 trillion. The program has been spending more than it takes in every year since 2021. The trajectory is not new, but the 2032 date makes it very real, very soon. This has happened before, and here is exactly how it was fixed. Here is something the news headlines are not going to tell you this week. This is not the first time Social Security has been at the edge of a funding crisis, and the last time it happened, Congress fixed it before the deadline. In 1983, Social Security was weeks away from not being able to pay full benefits. Congress passed the Social Security Amendments of 1983, a bipartisan package that included raising the full retirement age, increasing payroll taxes, and beginning to tax a portion of benefits for higher income earners. It worked. The trust fund was extended for decades. Social Security has never missed a payment in its entire history. Now, what are the options on the table today? The Trustees Report itself lays them out clearly. To fully close the 75-year funding gap, Congress could do one or a combination of the following. Raise the payroll tax rate, currently 6.2% for employees, by approximately 4.4% of payroll to cover the full shortfall. Or cut benefits immediately by approximately 17% for all current and future beneficiaries. Or some combination of both changes, phased in over time with smaller adjustments that are more politically palatable. Neither extreme option is politically popular, which is exactly why Congress has delayed acting for decades. But the 2032 deadline creates a forcing mechanism. A 22% automatic cut is something no politician in any district wants to explain to their constituents. The political pressure to act increases significantly as 2032 approaches. AARP's CEO said this morning, and I want to quote this directly because it matters, that no family should see cuts to what they have earned in Social Security. That statement from the largest senior advocacy organization in the country signals that the fight to protect these benefits is going to be loud, sustained, and bipartisan. That matters for your planning. The realistic scenario, based on how Congress has handled every similar deadline in modern history, is some combination of modest changes phased in that extend the trust fund. A complete 22% cut applied automatically to 71 million Americans is an outcome that would cause immediate and severe economic pain in every congressional district in the country. Congress knows this. That is not a reason to be complacent, but it is a reason not to panic. Stay with me, because the next section covers which seniors are most exposed to this risk, and the section after that is the 5 specific actions you can take right now, starting today, that put you in the strongest possible position no matter what Congress does. Who is most at risk, and which states get hit hardest? The groups and states with the most exposure, and why your situation is different depending on where you live. Not every senior faces the same level of exposure from this report. Let me walk you through the groups most at risk and the states where the impact would be most severe. Group 1. Current retirees who depend heavily on Social Security. According to a Senior Citizens League survey, 73% of retirees rely on Social Security for more than half of their income. 39% depend on it for all of their income. If you are in either of those groups, Social Security is not a supplement for you, it is the foundation. A 22% cut to the foundation is not an inconvenience, it is a financial emergency. For these seniors, the 2032 deadline is not abstract. It is a direct threat to their ability to pay for housing, food, and healthcare. Group 2, people currently aged 61 to 65. The trustees report specifically notes that when the trust fund depletes in 2032, today's 61-year-olds will be at their full retirement age of 67. If you are in this range, you are making claiming decisions right now, or will be within the next 2 to 6 years, in an environment where the rules may change before you collect for very long. This makes your claiming timing decisions more complex than they have ever been. Group 3, women and widows. Women, on average, live longer than men, which means they collect Social Security for more years and have more exposure to any long-term benefit reduction. Women are also more likely to be collecting on a survivor benefit at a lower rate than a working history benefit. A 22% cut on an already reduced survivor benefit is proportionally more painful. Now the state-by-state picture. The Committee for a Responsible Federal Budget published a report this week, No State Spared, that maps the exact dollar impact of a 24% cut on every state in the country. The 10 states where average beneficiaries would lose the most per month are Connecticut at $556, New Jersey at $554, New Hampshire at $553, Delaware at $549, Maryland at $541, Washington at $531, Minnesota at $530, Massachusetts at $527, Michigan at $523, and Utah at $523. Even the states with the smallest projected cuts, largely lower cost of living states in the South, would still see average cuts of $350 to $400 per month. No state is unaffected. No beneficiary is exempt. That is what the report means when it says the cut would be automatic and across the board. The 5 actions to take right now. What you can actually do, starting today, to protect your position regardless of what Congress does. Now, here is the section that matters most, because information without action is just anxiety. So let me give you 5 concrete steps, each one free, each one available to you right now, that put you in the strongest possible position between today and 2032. Action 1. Verify your Social Security earnings record right now. Your benefit amount is calculated based on your lifetime earnings record. If that record has errors, a year where your employer submitted the wrong payroll figure, a self-employment year that did not get recorded correctly, a job that closed and whose records were never transferred, those errors reduce your monthly benefit permanently. Each missed or incorrect year reduces your benefit by approximately $100 per month. Before any cut debate even begins, make sure your baseline benefit amount is accurate. Go to ssa.gov, create or log in to your My Social Security account, open your Social Security statement, compare your earnings listed for every year against your own records, W-2s, tax returns, pay stubs. If you find an error, file a request for correction of earnings record with supporting documentation. This is free, it is available right now, and it could add real money to your check before any political decision is made. Action 2. Check whether you are being charged a Medicare IRMAA surcharge you no longer qualify for. If your income has dropped since 2023 because you retired, lost a spouse, had a one-time income event, Medicare may still be deducting an IRMAA surcharge from your Social Security check based on that old income. This surcharge ranges from $69 to over $400 per month extra on top of your standard Part B premium. The form to appeal it is the SSA 44. Download it at ssa.gov, submit it with documentation of your current income situation. If approved, your surcharge drops and your net Social Security check goes up. This is money you should not be losing while you are also worried about a future cut. Action 3. If you have not yet claimed Social Security, run the break-even analysis for your specific situation before deciding anything. The 2032 trust fund situation is causing seniors who have not yet claimed to ask whether they should claim early, now, before any potential cuts. I'm going to cover this in detail in a separate video this week because it deserves its own full analysis. But the short answer is, do not make your claiming decision based on fear of 2032 without doing the math first. Claiming at 62 instead of 67 permanently reduces your benefit by up to 30%. If Congress acts and avoids any cut, you will have locked in a lower amount for life unnecessarily. Go to ssa.gov and use the retirement estimator to see your projected benefit at different claiming ages. Then make the decision based on your health, your other income, and your specific numbers, not based on headlines. Action 4. Check whether you qualify for the Medicare Extra Help program for prescription drug costs. If a 22% benefit cut does happen in 2032, the seniors who will feel it least are the ones who have already reduced their other monthly expenses as much as possible. The Extra Help program, also called the Low Income Subsidy, eliminates your Medicare Part D premium, eliminates the annual deductible, and caps your prescription copays at approximately $5 for generics and $13 for brand name drugs. If your income is below roughly $24,000 as a single person or $32,000 as a married couple, you very likely qualify. Apply at ssa.gov or call 1-800-772-1213. If you already qualify for a Medicare savings program, you are automatically enrolled in Extra Help. No separate application needed. Action 5. Know the $6,000 Senior Tax Deduction and make sure you are claiming it. The One Big Beautiful Bill Act, the same law that accelerated the trust fund depletion date, also created a new $6,000 tax deduction for every American aged 65 and older, $12,000 for married couples where both spouses are 65 or older. This deduction applies for tax years 2025 through 2028 and can eliminate Social Security taxes entirely for the majority of seniors. If you are filing your 2025 tax return, or if you have not yet filed and requested an extension, make sure your tax preparer knows about this deduction. If you already filed and did not claim it, you may be able to file an amended return. This is money that legally belongs to you. Do not leave it on the table. Let me bring everything together. This morning, the Social Security Administration confirmed in its official 2026 Trustees Report that the OASI Trust Fund is projected to run out in the fourth quarter of 2032. At that point, if Congress has not acted, benefits would automatically be reduced by 22% across the board. On a $2,000 check, that is $440 less per month. On a $2,500 check, that is $550. Social Security is not going bankrupt. Payments do not stop. The program keeps collecting payroll taxes and keeps sending checks, just at 78 cents on the dollar instead of the full amount. Congress has fixed this type of crisis before. The political pressure to act will intensify significantly between now and 2032, but you should not wait for Congress to act before taking steps to protect your own position. The 5 actions to take now: verify your earnings record at ssa.gov, check whether you owe an IRMAA surcharge you should not be paying, and file Form SSA 44 if so. Do not make early claiming decisions based on fear without running the actual numbers. Apply for extra help if your prescription costs are a concern, and make sure you are claiming the $6,000 senior tax deduction on your returns. This report is going to generate a lot of fear over the next few days, a lot of panic, a lot of misleading headlines. What I want you to take away from this video is not fear. It is clarity. You now know exactly what the report says, what it does not say, what Congress can do, and what you can do right now. If this video helped you understand the situation clearly, please share it with someone you know who is on Social Security or close to claiming it. A parent, a sibling, a neighbor who is going to see those headlines and not have anyone to explain what they actually mean. This week especially, one conversation can make a real difference. Subscribe if you have not already, and I will see you in the next one.